Welcome back, everybody. We're talking about the trade deficit today. We're going to explain what the trade deficit is, what the current account deficit is, and how this all relates to whether or not America is on the verge of bleeding to death due to foreign trade. All right, so a trade deficit is really basic, actually. A trade deficit just means that a country is importing more than it exports. So that basically means you buy more from foreign countries than you sell to those countries. So a trade deficit is when imports are greater than your exports. And for a really basic example of this, let's just say that the United States exports $3 trillion worth of goods, but imports $4 trillion of goods. Well, that means that they're running a $1 trillion trade deficit, meaning that we are buying $1 trillion more of goods and services from abroad than we are selling to foreigners abroad. So the best way to think about this is actually that we're sending pieces of paper out of the country in exchange for physical goods. And so this means that foreigners are getting pieces of green paper that we can make an infinite number of, and in exchange for that, we're getting real goods and services. So while we describe this as a trade deficit, it means that we are in fact also seeing the opposite side of that as a capital goods surplus. So you have to look at both of these items as a trade. You have a deficit of money flowing in versus flowing out, but you have a surplus of goods flowing in versus flowing out. So whether or not all of this is good for the economy on the whole really depends on a lot more context. So let's get into that. So economists actually measure this using what's called the current account. And so the United States runs a current account deficit, and the current account is the summation of the balance of trade, our exports versus our imports, plus all the financial transactions. So this includes things like our net income and net transfers. And this gives you a dollar value of the actual cross-border dollar flows that are moving in versus moving out of the country. So another crucial aspect about all this is that when those dollars go abroad, those dollars actually come back. And so this is really important because we're sending foreigners pieces of paper. Those pieces of paper ultimately come back to the United States when those foreigners buy US dollar denominated assets. And at the same time, we're getting goods and services. But what's even more important in all this is that Americans, and especially American corporations, have utilized all of this in a way that's been accretive to corporate profits and all of our net worths. Foreign trade and actually our current account deficit is one of the main reasons, or one of the main indicators that shows why we're so wealthy. And so as a simple example of this, consider a company like Apple, which Apple technically might run a current account deficit against China. So Apple has a lot of products that are built in China. Those products get imported into the United States. And if Apple doesn't sell more phones back to Chinese consumers, then Apple will end up running a current account deficit against China as a whole. But this is really important because although they're running a current account deficit, what Apple has really been doing is Apple has been leveraging what economists call their comparative advantage. Apple is outsourcing their ability to make these phones for less expensive and accruing higher margins by outsourcing this production and then importing those phones back in the United States and then selling them to US consumers for lower prices than we would otherwise pay. And this is also a net benefit to US consumers because what's happening here is that we're using the global competitive forces to help Apple build cheaper phones. And that's important for US consumers because what we're now able to do is we're able to spend less of our income on things like phones and computers and the things that Apple produces, which allows US consumers, due to this competitive force, to spend more money on other goods and services. And this is really the crucial aspect of this whole debate about tariffs and whether a current account deficit is a net benefit or a net negative for a country, because what things like tariffs do is tariffs reduce domestic competition. So the example that I like to use is, let's say that South Korea implements a tariff on foreign imports of American vehicles. And what they're trying to do is they're trying to protect their domestic automobile manufacturers. They might say that, Kia and Hyundai are crucially important car manufacturers and essential to the Korean economy. And what they're going to do is they're going to make it less competitive for Americans to compete with those firms. But what that ultimately ends up doing is it ends up giving those domestic car manufacturers pricing power. They're then able to operate more like an oligopoly. They're able to be a price setter in a way that competitive forces wouldn't allow them to necessarily be. And so because they have price power over their domestic consumers, the domestic consumers are worse off because the domestic consumers end up paying more for those cars than they might otherwise pay if there was more foreign competition. And that makes everybody worse off because what it ends up doing is, although it makes the car manufacturers better off, it makes everybody else worse off because now Korean consumers have less money to spend on all the other goods and services. That means that all the other corporations inside of the Korean economy are worse off than they otherwise would be. They hire fewer people, they pay people less, they earn lower profits. And so in the aggregate, while this is good for a sector, this is bad for the aggregate because the lack of these competitive forces from abroad is reducing the ability of domestic consumers to spend more of their income on other goods and services. And so that puts upward pressure on the vehicles that they're trying to protect. And it's what Milton Friedman called an invisible tax, because although it might look like on the surface that Korea is better off because of this, what the Koreans don't see is that in the aggregate, they're worse off because in this counterfactual example, the Korean consumers would have spent more money on other industries, on other goods and services. It would have broadened their economy. Their economy would have grew in a more diversified way. They would have had diversified employment. And so they don't see it, but the Koreans are worse off than they otherwise would have been. And this is one of the key reasons why America has grown so much richer than the rest of the world, is because we've rejected this sort of policies for decades and decades. Another aspect that's really important about understanding the context of a current account deficit or current account surplus is that you have to look at this in the context of the broader economy. And so in the case of the United States, we run about a $1 trillion current account deficit. So think of that as $1 trillion that are flowing outside of the country every year. But you have to look at what's happening within the economy too, because that just reflects our cross-border transactions. When you look at the domestic economy, we actually have $30 trillion of domestic income. And then you have the fact that all of this spending and the efficient way that our corporations and our consumers utilize all this accrues to things like our net worth. And when you look at the balance sheet and our net worth of all of this, well, the US private sector has $250 trillion of total assets. That's $1/4 of a quadrillion worth of assets versus liabilities of roughly $60 trillion in total. And so our net worth is close to $190 trillion on the whole, which means that when you put all of this in perspective, the way that I like to think of this is that we're the equivalent of a person that has a $250,000 group of assets versus a $190,000 net worth, and we earn about a $30,000 income. And at the same time, we also operate a foreign transactional account where we run a $1,000 deficit against some foreign company, for instance, that we purchase goods and services from. And so when you think of this in the broad context of the aggregate economy, in the scope of the United States especially, it's not that the current account deficit is a non-issue, but that $1,000 that is going out is in many ways accretive to our net worth because it's helping corporations optimize their margins and it's helping consumers consume more than they might otherwise be able to. But it's also just not a significant outflow in the grand scheme of things where you would say that, hey, this is causing, for instance, the US economy some risk of bleeding out or bleeding to death in the long run. All right, so it's important to look at deficits and surpluses in the right context because you don't want to just look at assets and liabilities and assume that having a certain amount of liabilities or a certain amount of deficit is inherently bad. There's nothing inherently bad about deficits or liabilities in and of themselves, but this is not to say that liabilities and deficits, especially current account deficits, couldn't become a big problem. And I would say that there are two really big risks with running a current account deficit and being somewhat reliant on foreigners to fund things like corporate margins and corporate profits to some degree. And those two big risks are that, well, first of all, you have $1 trillion of dollars that are flowing outside of the economy every year, and that could create internal problems. And that is roughly $1 trillion that, in a lot of ways, from an income statement perspective, from a cash flow perspective, that money does need to be offset to some degree. So you would need other balance sheets inside of the domestic economy to be offsetting that to some degree. And that could come from, say, the government printing money to spend more to offset that, or it could come from domestic borrowing. And so you could have a scenario where, for instance, domestic borrowers are having to leverage themselves up because you have this foreign outflow of dollars. And that could create its own sort of risks where in environments like, say, the housing bubble, I would say that the current account deficit probably contributed to the housing bubble in a certain degree, where households and domestic consumers were getting leveraged up in a certain way that, in tandem with the outflow of the current account deficit, made the domestic economy more fragile than it would otherwise be. And so the other big risk with this is that you could have an environment where domestic corporations, for whatever reason, maybe they're not using that outflow in the efficient way that they currently do. And so the current account deficit as it currently is largely reflects the efficient use of corporations leveraging low-cost manufacturing from abroad, for instance. And that is accretive to corporate profits and corporate net worth. But that's not guaranteed. You could certainly have a scenario where, say, to go back to our other example, we were just buying nonsense or wasting money on garbage and sort of bad investments. Let's just use an example of $50,000 a year, where we were then spending $50,000 abroad for things that weren't necessarily accretive to our net worth and to our corporate profits domestically. And that would be a big unsustainable problem for somewhat obvious reasons. And so you don't want to be blasé about this. There is a scenario where these things could certainly become really bad. And so to put this in context, let's review a couple of the most recent balance of payments crises that have occurred. And it's important to note these are typically emerging market phenomena. So you typically have small, closed, emerging market economies that have some sort of specific isolated problem occurring inside of the domestic economy. So for instance, in the case of Thailand in the 1997 Asian financial crisis, you had a very acute speculative real estate bubble. And you'll notice that one thing that's common across these types of crises is that they're often using a pegged foreign exchange rate. So the economy is typically a closed economy to a large degree that relies very specifically on pegging the exchange rate to a foreign currency. And so in many ways, they're adopting a foreign exchange rate. And this is typical across almost all of these examples. And so in the case of Argentina, you had a fixed peso dollar peg, you had a high government debt, and then you had the persistent current account deficit. And the impact ultimately was very high inflation and a very deep recession. And in the case of Greece, that was a unique one in the sense that the European Union is essentially one fixed foreign exchange rate across the entire union. And Greece had a very acute exposure to this because they're so dependent on basically their internal current account deficit relative to the rest of the European Union. And they're highly uncompetitive inside of the union because of this. And so the ultimate result of that recession was a huge contraction in GDP and massive unemployment, but also due to largely the way that the fixed exchange rate occurs inside of the European Union. And then the most recent one was the kind of rolling crisis that we have going on in Turkey. And that was, again, a large balance of payments deficit, very heavy foreign currency debts, very high rate of inflation, and very pro-cyclical political risk that's occurring in large part because monetary policy and fiscal policy are both very highly correlated now, the way that President Erdogan has adopted this sort of unorthodox, almost MMT-like style of policy management. And the result there has been a huge rate of inflation, very high borrowing costs, and a sort of rolling recession. So at present, I wouldn't say that any of these things really apply to the United States. I mean, we're the farthest thing from an emerging market economy that you could pretty much ever have. And we don't have a foreign pegged currency. So those are two really crucial differences when you're talking about the historical balance of payments crises that have typically occurred and the way they unfold over time. But that doesn't mean that we couldn't evolve into that at some point in the next few decades or so. And so a few of the things I would keep a really close eye on to manage this and monitor whether or not the balance of payments crises risk is increasing in the future is you'd want to, first of all, look at whether or not the foreign exchange rate is depreciating sharply. You'd also probably get in the United States a rolling and persistent rate of increasingly high inflation. So in an environment like, say, the 1970s, where we had a 10% rate of inflation, if you had a coinciding balance of payments, I would say that the potential for a currency implosion there increases significantly when you have inflation, because inflation typically is already indicative of a falling rate of demand for the domestic currency in the first place. And then this would probably coincide with very high borrowing rates and most likely recessionary-like environments. But I wouldn't say that the United States at present is anywhere close to that. And in fact, based on virtually all of the wealth metrics and all of the GDP growth metrics and all of our rankings, whether it is GDP per capita or GDP in total, GDP growth rates within the G7, and even things like real median wealth, and real median incomes, which have grown significantly over the course of the last 50 years. I wouldn't say any of this is unsustainable at present, but that doesn't mean that this can't become a big problem in the future. It just means that at present, this is not nearly the problem that I think a lot of people who look at a deficit are necessarily assuming that it is just because it's called a deficit. All right, so the big conclusion here is that although the United States runs a $1 trillion current account deficit, that deficit is in many ways accretive to the other surpluses that we run, primarily the surplus of net worth of households and corporations especially. And so in the grand scheme of things, although we do run this current account deficit with the rest of the world, it's much more important to put this in the context of the total balance sheet and, more importantly, the total income statement of the domestic economy, because the domestic economy with $30 trillion of domestic gross income is vastly larger than this dollar outflow that we experience from abroad. And so there's no scenario at present where I see this as being unsustainable or something that is inherently detrimental to the future of the United States.